Look, forget everything you thought you knew about buying a home. Seriously. In the cutthroat reality of the 2026 real estate market, scrolling through property listings before you have your verified capital sorted out isn't just a slight misstep. It's a guaranteed way to lose. Right now, we are operating in a wildly complex economic environment. It's defined by intense volatility, historically strict underwriting standards, and fierce, uncompromising competition for a severely limited supply of homes. The old playbook, window shopping your way into homeownership, yeah, that is completely dead. So today, in this explainer, we're going to break down the exact blueprint you need to survive and actually win in this environment. We're going to completely flip the script on how you acquire real estate by mastering what is known as the lender-first paradigm.
80%. Let that number sink in for a second. According to the latest market analytics, that is the staggering percentage of U.S. homeowners right now who are locked into mortgage rates below 6%. I mean, think about the psychology of that. If you're sitting on a mortgage at 3 or 4%, you are structurally disincentivized from ever selling that property just to take on a new loan at current market rates, right? This lock-in effect isn't just some minor hurdle. It is literally choking housing inventory across the entire country. We are dealing with a persistent, massive structural supply deficit. And because of this artificial scarcity, when a truly good property actually hits the open market, you are virtually guaranteed to be stepping into a multiple offer scenario. In this ruthless environment, aesthetic preferences or, writing charming letters to the seller, that doesn't win deals anymore. Absolute speed and verified capital are your only true advantages.
All right, let's dive into our first major shift, the lender-first paradigm. The old way of doing things, what we call the agent-first approach, is totally obsolete. Honestly, this is exactly how your parents probably bought a house. You find a real estate agent, you spend your weekends browsing open houses, you fall head over heels in a place, and then you frantically scramble to figure out how to actually pay for it. That entire process is property-centric and entirely reactive. By the time you start looking for financing, you're already in escrow and the clock is ticking against you. But the 2026 lender-first strategy completely inverts this. It is capital-centric. Before you ever set foot on a property or look at a single listing online, you sit down with a mortgage professional who effectively acts as your financial architect. Together, you design your capital structure, you evaluate the true long-term cost of borrowing, and you manage your risk proactively. You build an unshakable financial foundation first, and then your real estate agent executes the property search within those strictly defined ironclad parameters. Now, you might be wondering, what's the biggest emotional and strategic benefit of acting capital first? It's avoiding what industry insiders call price range heartbreak. We've all done it, right? You start your journey by playing around with those basic online mortgage calculators. You think you can afford a specific tier of homes. You go tour a house, you start mentally arranging your furniture in the living room, you imagine your whole life there, only to realize later that once the total true cost of homeownership is factored in, you simply cannot afford it. We're talking about property taxes, homeowners insurance, strict HOA dues, and the harsh realities of the current rate environment. Experiencing that realization? It's exhausting emotional whiplash, and frankly, it's a massive waste of your time. Establishing a verified budgetary guardrail with a lender upfront prevents this trap completely. You only ever look at properties that you have the definitive power to acquire. Moving on to Section 2, let's talk about pre-approval, and specifically treating it as your negotiating weapon. Okay, there is a stark contrast between two distinct terms that buyers constantly mistakenly use interchangeably: pre-qualified and pre-approved. Let me be crystal clear. In the reality of 2026, a pre-qualification is basically worthless paper. It's nothing more than a verbal overview based entirely on self-reported data. You tell a lender what you make, and they guess what you can afford. Sellers and listing agents in this ultra-competitive market will absolutely not take a pre-qualification seriously. A pre-approval, on the other hand, that is your primary negotiating weapon. A true, battle-tested pre-approval involves a hard credit review, deep asset verification, rigorous income documentation, and actual submission through an automated underwriting system. When you hand a seller a real pre-approval letter, you are signaling with absolute authority that you have been thoroughly vetted. You are proving that you are a low-risk buyer who actually has the verified capital to close the deal. So how exactly do you forge this negotiating weapon? Well, you follow the 2-2-2 rule. This is the foundational rigorous audit required by any serious lender to secure your pre-approval. You need to provide 2 months of comprehensive bank statements, 2 of your most recent pay stubs, and 2 full years of W-2s or tax returns. Be fully prepared to hand this exact documentation stack over on day 1 of your home buying journey. And here is a totally critical takeaway. Total financial transparency is mandatory. Hiding debts or making sudden financial moves will absolutely destroy your leverage. Unexplained large deposits, opening a new credit card to buy furniture, or deciding to finance a new car during the mortgage process can, and for sure will, trigger a total loan denial just days before closing. 10 to 21 days. That is the blazing closing velocity you can achieve when you deploy a fully underwritten pre-approval. Now, why does this specific timeframe matter so much to us? Because in real estate, cash buyers traditionally win by offering absolute certainty and speed. But by utilizing automated underwriting, you can match that exact speed. This strategy is incredibly potent, especially for real estate investors using a debt service coverage ratio, or DSCR loan. While a traditional conventional loan might drag on for 30 to 45 days, agonizing over your personal W-2 income, a DSCR loan evaluates the investment property's own rental cash flow. Paired with automated underwriting, an investor can confidently close a deal in 10 to 21 days. This kind of institutional velocity can literally obliterate competing cash offers, because you are bringing fully backed capital to the closing table just as fast, effectively neutralizing the cash buyer's biggest advantage. All right, let's shift gears to Section 3, the Insurance Mortgage Nexus. Let's define the fundamental philosophy of holistic risk management. The Insurance Mortgage Nexus is the strategic integration of life and disability insurance policies directly into your home buying process. Because a true financial architect doesn't just get you the keys to the front door, they ensure your long-term home ownership solvency. Think about it. Your home is very likely your family's largest asset, but it is also simultaneously your family's largest financial liability. If an unexpected health crisis strikes or a sudden loss of income occurs, a carefully constructed real estate portfolio can collapse overnight. Implementing a structural, holistic risk management plan ensures that the wealth you just worked so hard to acquire is actually preserved for the long haul. Your financial shield really relies on 4 distinct components, and you have to notice the key differences in exactly how they protect you, and more importantly, who actually receives the money. Mortgage protection life insurance pays off the declining balance of your loan if you pass away, but it pays the lender directly. Conversely, level term life insurance pays a fixed amount directly to your survivors. This provides your family with high flexibility. They can choose to pay off the house entirely or use that cash for other vital living expenses. But here is an incredibly crucial fact to consider. The statistical risk of experiencing a severe disability during a standard 30-year mortgage is actually much higher than the risk of premature death. That's where disability insurance comes in. Mortgage disability covers your monthly PITI. That is your principal, interest, taxes, and insurance. It prevents foreclosure, but again, the payout goes straight to the lender. Individual disability, however, replaces a high percentage of your total income, and it pays you directly, which supports your entire household budget, not just the mortgage. An expert lender is going to weave these specific policies into your master plan before you ever close. Which brings us to our final section, your financial architecture. I want to deliver a highly urgent, really powerful quote directly from our source material regarding the realities of the 2026 market. It says, "The question isn't whether you can afford to buy, it's whether you can afford to wait." The macroeconomic reality right now is just unforgiving. Rents are continuing to climb aggressively across the board. Waiting on the sidelines, hoping for a massive, unprecedented drop in interest rates or a sudden flood of new housing inventory that simply isn't coming, well, it is a mathematically losing strategy. The way you actually win is by stopping the casual window shopping. You win by sitting down with a dedicated mortgage professional and actively building a capital-first, structurally sound framework. So, I've got to ask you this final, provocative question to leave you with today. Is your financial architecture fully built? Or are you outgunned before viewing your first listing? If you are still out there relying on basic online calculators and endless Zillow searches without a fully verified, deeply underwritten pre-approval and a holistic risk management plan, you are literally bringing a knife to a gunfight in 2026. You are competing against buyers who have institutional speed and verified backing. It's time to take control of your position, consult a local mortgage ally, and build your blueprint from the ground up. Thanks so much for joining me on this explainer, and I'll catch you next time.